Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.
Hello and welcome again to this week's episode of Inside Options. Joining me is James Boardman from the Equity Derivatives Division of the JSE. Last week we looked at Delta and Theta and dynamic hedging. This week we're looking at volatility, I believe, James.
Absolutely. Implied volatility. 2 weeks ago we spoke about implied volatility in the light of the Black-Scholes model that we were discussing.
You could input.
That's the key input you put in. And with that change in input, you can get any price you want. And it's quite important to understand how implied volatility works. It's the price of volatility forecast by the market implied in option prices. That's where the implied and the implied volatility comes from.
All right, so just a note before we move on that if you do want to catch up with those episodes from last week and the week before, you can go to Summit's website, which is www.summit.co.za, or else the JSE's website as well.
So last week we looked at Delta, which is the hedge ratio. What proportion of stock do you need to have to keep your options in balance to be hedged? And also Theta, the rate at which your options are expiring and how fast their value is decaying as time passes. So we've got quite a few other Greeks we need to look at. Tonight's just all about implied volatility. But let's just have a look at some of those sort of risks. You can see that last week we looked at an option writer. So this is the guy sitting on the weekend. He's going to come in on Monday morning and find, woohoo, I've got that little dividend of my Theta trickling over the weekend. So you'd think he'd be quite a relaxed guy. Sadly, this is not the case. Option traders are more like this. In a room, busy, on their phones, shouting. This is actually a shot of an ICAP brokerage room somewhere in the world when the US Fed has just announced they're changing rates. So it's frantically busy. That's more what an option writer is like all the day. All day long, he's busy rebalancing his portfolio and managing his risks. So to manage those risks, he's got to measure them. So what are some of the measures of risks we look at with options? There's Delta, so this is the correct proportion of stock we need to hedge our position. There's Theta, this is how fast are our options expiring? Is it working for us or against us? There's Vega, we need to check how our forecast of the odds is comparing with the current forecast of the odds implied by the market. So perhaps we sold our option too cheaply, perhaps we got a really great price and the forecast odds have decreased. So that's a very, very important thing. The other one we looked at was Gamma.
Yeah.
So Gamma is the rate of change of Delta. If the scales are changing so fast we can't balance them, there's a serious risk of getting out of balance, and that can cost us quite a lot of money. How fast is your Delta changing? So we're adding weights frantically until the whole scales breaks down. And that's the worry with managing your Delta.
And this takes us back then to the Black-Scholes model as well.
Exactly. Now the Black-Scholes model helps us to manage all these risks. The calculator on our website at jse.co.za/bscalc, CALC, that'll show you can calculate all your option Greeks and look at all of them there. So the great thing about Black-Scholes, it provides a lovely framework that we can use to analyze and assess the risk of an options position. So we can look at the premium risk, the volatility risk, the Delta risk, the Theta. We can look at all these things just using our Black-Scholes model. So it's a very useful framework about which to think of the different aspects of option risk.
James, talking about the Black-Scholes model, it's not infallible though, is it?
Absolutely not. It's very, very useful for measuring and managing our risks, but there has been a very recent interesting critique by one of finance's most well-known figures. That's Warren Buffett. So he's critiqued the Black-Scholes model, and because of his critique of it, he's written a lot of long-dated puts. In 2007, I've actually got the dates when he actually did the transaction. So here he is playing the ukulele. Now Warren Buffett is the world's second richest man. Yes. He's so rich that people wow at his ukulele playing. Moreover,
overlook it, perhaps.
They overlook perhaps the fact that he does make them endure his ukulele playing, because he's got such incredible returns for investors over the years. He was recently ranked as the best investor of the 20th century. So he's recently gone in a big position and sold a lot of long-dated puts. He received premium of $4.5 billion for writing long-dated puts on 4 major global indices, one of them being the S&P 500. So those are sort of at-the-money prices, the big worry from a bunch of sort of insurers, various people on the other side, was that what happens if there's deflation and the market sort of decreases? He feels quite strongly they've just taken some mark-to-market losses on the revalue of those puts. And he said really disagrees with the Black-Scholes model quite strongly. It's quite interesting, some of the stuff he said. He just says for very long-dated options, these are 15 to 20-year options. So there's a lot of risk, and it's quite tricky to manage them, a very long-term time frame. So why did he sell those puts? I'd say, to me, I think it's about value. It's about value. So how do you find
Because he
value?
is a value
He's
investor.
a value investor. I mean, he was taught by Benjamin Graham, who sort of invented that whole idea of securities analysis. And the idea behind Benjamin Graham's thing is you look at a company and you value it independently, and you say, right, what is this company actually worth sort of as a whole? What is my little piece of it worth? Now, there's this crazy guy called Mr. Market, and he's out there. Sometimes he's really down in the dumps, and he'll sell that whole company to you for an absolute pittance. Sometimes he's super over optimistic, and he'll pay you far, far more than that company's actually worth. So what you need is your own independent measure of that value, and then to look at what the market's doing relative to your own independent measure of value. So when you see these opportunities and a great company is going for cents in the rand, that's when the value investor pounces. But you have to have that independent valuation. So why would he sell puts? I think it's because he found value. Now, how do you identify value in options? The main way we do that is through looking at implied volatility. So you've got to remember what we said about implied volatility in the Black-Scholes model. Bruno Dupier, the head quantitative analyst at Bloomberg, he explains implied volatility very, very nicely. He says implied volatility is the wrong number that we put into the wrong model to get the right price. So that's the cool thing about that implied volatility. We can tweak that and come up with some reasons for why we've tweaked it to get whatever price we want. That's why quite a few people sort of critiqued Warren Buffett saying it's broken, because all you've got to do is change that one assumption and have some reasons for changing that to get to any kind of price that you want the model to kick out. So the Black-Scholes model has a lot of assumptions. It assumes we can trade at every level the market passes through. It assumes that volatility is constant over the life of an option. It has a lot of flaws, there's no doubt about that. But because we can tweak just that one parameter of the implied volatility to get the correct answer that we want, it's still a very, very useful and intuitive model.
James, we're going to pause there for a second. When we get back, I think you've got something called Goal Seek in Excel, which will help you manage that, the implied volatility. Exactly. We'll be back right after this break.